The last few years have felt like a new financial chapter opening in front of us, one where technology is no longer just influencing the world. It is shaping almost every decision made in boardrooms, trading floors, and government policies. Markets move faster, news cycles shrink, and every trend seems to become a global event in a matter of hours. Yet, beneath this speed and excitement, a different kind of pressure has been building. Investors are chasing breakthroughs at a pace that leaves very little room for doubt, and the lines between innovation and overconfidence are becoming thinner than ever. The rise of artificial intelligence propelled this energy to a new level. Companies across the world began pouring billions into AI, convinced that whoever invests the most will dominate the future. Stock prices surged, expectations skyrocketed, and every earnings call turned into a competition over who spent more on AI, who trained larger models, and who built bigger server farms. The logic felt simple. More investment means more growth. But the story beneath the surface is rarely that simple. When almost every company begins believing the same narrative, it becomes difficult to separate genuine progress from collective enthusiasm. This is the atmosphere in which Michael Burry reappears as a voice that demands attention. He is not an influencer, nor a constant commentator chasing headlines. He speaks rarely, but when he does, people pause, not because he is always correct, but because he has an uncanny ability to see structural problems before they become market-wide disasters. His warning before the 2008 crisis was met with dismissal, yet the same skeptical pattern has followed him for years. He points to the weak spots when everyone else is celebrating. Investors listen to him today not because he predicted one crisis, but because he understood the mechanism behind it. The combination of human optimism, financial engineering, and structural weaknesses hidden in plain sight. Those elements, in different shapes, continue to appear again and again in the global financial system. Whenever markets grow rapidly and expectations become extreme, his perspective becomes valuable, not as prophecy, but as a reminder that growth built on fragile foundations eventually demands a price. The current market environment reflects this balance of excitement and risk. AI companies broke spending records. Chip manufacturers reached valuations that would have been unthinkable a decade ago, and data center expansion became the new arms race. At the same time, global debt rose. Interest rates stayed elevated longer than expected, and households struggled with higher living costs. These contradictions make the financial landscape unstable, even if the surface appears strong. It is exactly in such moments that early warnings tend to emerge, not to predict immediate collapse, but to highlight where pressure may be silently increasing. Michael Burry points toward that pressure. He focuses on details that are easy to overlook, such as the cost of maintaining AI infrastructure, the accounting treatment of depreciation, and the possibility that earnings may not fully reflect the true expense of running massive compute systems. These are not dramatic predictions. They are technical concerns. But technical concerns often reveal the most dangerous blind spots. When markets become enthusiastic about a new technology, they often underestimate the long-term cost of sustaining it. History shows that excitement creates a temporary sense of certainty, even when the underlying math begins to weaken. This is why Burry's voice still matters today, not because he is predicting an immediate crash, but because he is reminding investors to look at the parts of the system that enthusiasm tends to hide. In a world racing toward AI with extraordinary speed, the weaknesses are not always found in the technology itself, but in the assumptions surrounding it. The pressure often builds quietly, layer by layer, inside financial statements, capital expenditures, and expectations that assume growth will continue forever. The story of this era is not just about technology transforming society. It is also about how markets interpret that transformation, how investors react to it, and how easily optimism can evolve into something unstable. Understanding this environment is essential before exploring any deeper warnings. Only when the bigger picture becomes clear can we begin to understand why certain voices, especially skeptical ones, rise to the forefront during times of extraordinary excitement. Throughout history, financial markets have displayed a remarkable ability to repeat themselves, not in exact detail, but in patterns of behavior. Bubbles are rarely sudden. They develop slowly, often invisible to those caught up in the excitement. Investors convince themselves that this time is different, that new technology, new markets, or new policies will break the old rules. Yet beneath the optimism, common threads appear. Rapid asset price increases, overconfidence, excessive leverage, and an underestimation of risk. The dot-com bubble of the late 1990s serves as a striking example. Companies with little more than a website or a business plan were valued in the billions. Analysts celebrated every new idea. Investors poured money into every IPO, and a culture of growth at any cost prevailed. Many of these companies had no real earnings, no sustainable revenue, but their potential seemed limitless. Eventually, reality caught up. Revenues failed to match expectations, debts mounted, and the market experienced a painful correction, wiping out trillions of dollars in value almost overnight. The housing crisis of 2008 followed a different sector, but echoed the same dynamics. Mortgage-backed securities promised high returns. Rating agencies relied on flawed assumptions, and risk was hidden in complex financial structures. People assumed that housing prices would always rise and ignored the signs of excessive borrowing. The warning signals existed, but they were technical, buried in footnotes, or obscured by euphoric market sentiment. Only a few investors, like Michael Burry, noticed the mispricing of risk and prepared accordingly. When the system finally corrected, the fallout was severe, affecting not just investors, but the global economy and millions of households. Bubbles are, in essence, human phenomena. They rely on psychology as much as economics. Greed pushes people to chase gains. Fear often arrives too late, and confirmation bias makes warning signs easy to dismiss. This repetition is critical to understand because the same behavioral patterns appear in almost every speculative boom. Even as technology changes, the fundamental dynamics remain. Rapid adoption, overvaluation, misaligned incentives, and the tendency to ignore structural weaknesses. Looking at the current AI-driven financial surge, it is easy to identify echoes of past bubbles. Companies have been investing at unprecedented rates, raising capital aggressively, and expanding operations with the belief that demand will continue growing indefinitely. Yet beneath the excitement lie costs that are substantial and sometimes hidden, like infrastructure, depreciation, hardware replacement cycles, and the enormous expenses associated with data centers and AI model training. Investors tend to focus on headlines and projections, while these underlying pressures accumulate quietly. Markets often behave as if short-term optimism can overcome long-term risk. The psychology is predictable. Early gains reinforce confidence, which draws in more capital, which inflates prices further. Analysts begin issuing reports based on narrative rather than fundamentals. News cycles amplify the hype, and retail investors, seeing only success stories, pour in their savings. In this environment, skepticism is rare and sometimes unwelcome. Those who question assumptions are labeled pessimists or contrarians, even if their concerns are grounded in hard data. Michael Burry's perspective is valuable precisely because it confronts this behavioral tendency. He examines the mechanics of the bubble, not just the surface-level excitement. He looks at capital deployment, accounting practices, and structural assumptions. By identifying subtle weaknesses before they become obvious, he highlights risks that the majority are unwilling or unable to see. This approach reflects the same careful attention that allowed him to predict the housing crash, focusing on the fundamental mathematics rather than the story everyone wants to believe. Recognizing patterns is not about predicting exact outcomes or timelines. It is about understanding where pressure points exist and how behavior can amplify them. Bubbles tend to follow a recognizable arc: early enthusiasm, rapid expansion, widespread acceptance, excessive leverage, then a triggering event that reveals underlying fragility. Each stage can last months or years, but the underlying psychology is consistent. By studying these historical arcs, it becomes easier to evaluate the current market and see where structural weaknesses may be quietly accumulating. Ultimately, the lesson from past bubbles is clear. When markets act as though growth and innovation will solve all problems, it is often a signal to scrutinize the details. Numbers, accounting practices, and long-term costs cannot be ignored. The same patterns that appeared in dot-com stocks or mortgage-backed securities are observable in modern tech markets. Understanding these patterns is essential before diving into the specifics of what Burry has identified in AI companies today. The heart of Michael Burry's current warning lies not in headlines or hype, but in the subtleties of corporate accounting. At first glance, the staggering growth of AI companies appears unassailable. Revenue reports are impressive. Stock prices soar. and investors celebrate every announcement of new breakthroughs. Yet, as Burry observes, the underlying numbers often hide significant risks, particularly in how companies account for the costs of their AI infrastructure. This analysis comes from Michael Burry's public posts and filings this month. We cite his ex-post and reporting from major outlets in the description. One of the central concerns is depreciation. Every large-scale AI project relies on expensive hardware servers, specialized processors, storage systems that wear out or become obsolete rapidly. The cost of replacing or maintaining this equipment is not trivial. Depreciation, in accounting terms, is how companies spread the expense of these assets over their useful life. When done accurately, it ensures that profits reflect the real cost of doing business. When done aggressively or selectively, it can create the illusion of higher earnings, masking the true financial pressure. Burry's critique is that many AI firms are underestimating depreciation, reporting profits that do not fully consider the rapid turnover of their hardware. According to Michael Burry's public estimate, understating depreciation could amount to about $176 billion across major tech firms between 2026 and 2028. Attribution: Michael Burry. Public post: by minimizing these costs, companies may present a performance picture that seems far healthier than reality. To visualize this, imagine a massive iceberg. The visible revenue is the tip, but the hidden cost, the depreciation burden underneath, is a cumulative figure that could eventually shift the weight of the entire sector. To understand why this matters, consider the scale of investment in AI. Companies like Nvidia, Meta, and other hyperscalers are investing billions in servers and cloud infrastructure. AI model training alone consumes enormous amounts of computational power, which, in turn, requires regular hardware upgrades. The faster the hardware becomes obsolete, the more depreciation should be recorded to reflect the true expense. If these costs are understated, profits appear inflated, potentially misleading investors, analysts, and the market itself. Burry warns that the cumulative effect across multiple companies could significantly distort the market's perception of profitability. When the market eventually reconciles these adjusted numbers with reality, valuations could be recalibrated sharply, and the correction may be sudden. This is what Burry sees as the hidden risk. A risk that many are overlooking because it is technical, not immediately visible, and easily overshadowed by narratives of growth and innovation. Moreover, Burry emphasizes the importance of critical examination of balance sheets, rather than relying solely on headline revenue and profit figures. He scrutinizes capital expenditures, amortization schedules, and asset lifecycle. By focusing on these details, he identifies vulnerabilities that the broader market overlooks, a consistent part of his investment strategy. Another factor Burry highlights is human overconfidence. When companies and investors alike believe that technology guarantees continuous growth, small accounting choices such as depreciation schedules can have outsized effects. Optimism can blind people to technical details, and in a high-speed market, the consequences can escalate quickly. Profit figures, influence, investor behavior, stock valuations, and capital allocation, creating a feedback loop where initial inaccuracies can snowball into larger systemic risks. Importantly, Burry's concern is not a condemnation of AI itself. He acknowledges its transformative potential. His problem is with how financial risk is represented and whether earnings truly reflect costs. By highlighting these hidden accounting pressures, he is not predicting the immediate collapse of tech, but warning that the apparent strength of AI companies may be overstated. In essence, Burry reminds us that financial stability is built on accurate cost accounting, not just on growth stories. In industries driven by innovation and rapid expansion, this principle becomes even more critical. Ignoring depreciation and structural costs may not bring about an immediate crash, but it can amplify vulnerability over time, turning small miscalculations into major consequences. If market sentiment shifts, understanding these hidden pressures is the first step in assessing broader risk in AI markets. It is the lens through which Burry evaluates companies, not by the narrative they present publicly, but by the numbers they report internally. The gap between perception and reality, he argues, is where the most significant danger lies. To truly grasp the scope of the risks Michael Burry highlights, we must examine the companies at the center of the AI surge. These concerns are not hypothetical. They are rooted in real-world investments, real hardware, and real accounting decisions. By looking closely, we can understand how huge expenditures, rapid tech cycles, and aggressive growth strategies combine to create hidden vulnerabilities. Consider a leading AI chip manufacturer. Their GPUs are central to training AI models globally. Each new generation of chips boosts performance dramatically, yet old units depreciate quickly. Firms deploying these devices must replace hardware often, sometimes within just a few years to stay competitive. On the books, these replacements should be captured via depreciation schedules. But if these schedules are overly generous, profits look stronger than they truly are. The scale of such investment is immense, billions per year, enough to rival the GDP of small nations. Yet, these numbers may conceal a fragile financial base, one that could be destabilized if replacement costs accelerate or demand drops. Next, think of a global AI platform provider. Their business depends on continuous development of large-scale models and hosting for clients across industries. Every new AI model needs not just massive compute power, but loads of energy, specialized storage, and ongoing maintenance. Because innovation in this space moves fast, hardware becomes outdated quickly. If depreciation accounting does not fully reflect this accelerated turnover, reported profits can be misleading. Investors and analysts may assume financial robustness, unaware that replacement costs will rise sharply. Another example: companies leveraging AI-driven analytics across business sectors. These firms may report strong growth in AI-powered services, but behind the scenes, they're pouring capital into infrastructure servers, cooling systems. Data storage must expand continuously. If their depreciation and maintenance costs are underreported, their true financial burden is hidden. Burry warns that this does not necessarily lead to immediate disaster, but sets up a scenario where earnings could later surprise to the downside. Beyond individual firms, the broader AI ecosystem matters. Suppliers, hardware producers, and cloud service providers are all interconnected. If infrastructure costs are misrepresented or depreciation is underestimated, the risks reverberate across multiple players. Investors may assume stability, while a growing pool of liability accumulates quietly. This is the kind of systemic fragility Burry points to, not in a single company, but embedded in the full operational structure of the sector. Speed of expansion is another serious factor. Many AI companies have committed to huge global deployments, anticipating demand that might not scale as fast as promised. Every data center, GPU cluster, and server farm comes with capital cost and ongoing operational expense. While early revenue may absorb initial costs, replacement and maintenance expenses build over time. If financial statements don't fully reflect these obligations, future earnings could look artificially healthy. When the market eventually recalibrates, the adjustment could be painful. These case studies highlight a fundamental tension. Massive ambition creates opportunity, but also magnifies risk. Large-scale spending drives innovation, but miscalculations in depreciation, replacement cycles, and accounting assumptions can compound into real financial stress. Equipment, ASIAs, costs escalate, and the accounting decisions made today may not fully capture these future burdens. By studying how these companies spend, deploy, and report on their AI operations, one begins to see where the most significant vulnerabilities lie. Burry's argument is not that these companies are doomed, but that they may be more fragile than they appear. And in a market run on optimism, structural fragility often remains invisible until reality forces a reckoning. In short, the seeming strength of AI may conceal real operational and accounting pressure. Pressure that could reshape earnings, valuations, and investor expectations when the market finally takes a closer look. Michael Burry's investing style is distinctive, not because he seeks fame or headlines, but because he reads markets differently than most. In environments full of momentum and optimism, he hunts for structural imbalances and hidden risks. While others lean into narrative, he leans into mathematics and assumptions. This contrarian mindset helps him spot opportunities and dangers long before they become mainstream. Patience is one of the keystones of his approach, but he doesn't chase trends or follow market. He invests when conditions suggest that prices don't reflect real risk, even if it means appearing out of step. In the early 2000s, this let him foresee cracks in the housing market. Today, he applies that same patience to examining AI firms, looking for the gap between hype and hidden costs. He favors asymmetric bets rather than placing large, evenly distributed investments. He seeks situations where a smaller position could pay off significantly if the market corrects. In the AI context, that could mean identifying companies whose growth story hides aggressive accounting or unrecognized replacement costs. These are the firms where a correction, if it happens, might produce outsized movement relative to the risk. Another key strength is his meticulous research. He reads financial statements, studies, footnotes, and analyzes capital expenditure trends. Instead of relying on quarterly headlines or narrative-driven analyst reports, he digs into depreciation schedules, asset lifecycle assumptions, and the true cash cost of operations. That level of detail helps him find vulnerabilities others miss. Psychology also plays a role in his strategy. Being a contrarian often means resisting social pressure. When optimism abounds, skepticism can be lonely or unpopular. Burry has shown a willingness to stand alone in such climates. He understands that collective exuberance can inflate valuations far beyond reality, and that by the time many realize the risk, corrections can be swift and painful. In the current AI surge, his bets are deliberate. By focusing on infrastructure costs, accounting practices, and the life cycle of assets, he signals where the crowd is overweight on narrative and underweight on fundamentals. His positions are not meant to make headlines. They are built on evidence, discipline, and asymmetry. Finally, Burry's long-term perspective gives him strength. He doesn't react to every tweet or quarterly earnings miss. Instead, he looks at how structural vulnerabilities might play out over months or years. In his view, the biggest risks in AI may not be when things go right, but when the long-term cost of maintaining and renewing expensive infrastructure becomes impossible to ignore. In sum, his contrarian approach is about clarity, separating hype from danger, identifying weak points in enthusiasm, and positioning for risk rather than momentum. That strategy has made him one of the most unlikely but successful voices in multiple market cycles. And now, he applies it to a world racing headlong into AI. While the technology, the industries, and the timelines may differ, the psychological patterns between the 2008 housing bubble and today's AI surge reveal striking similarities. Human behavior, more than any particular asset, drives these cycles. Greed, overconfidence, and herd mentality have always been constants in financial markets, and they are as visible now as they were 15 years ago. In 2008, investors were captivated by rising home prices and the promise of constant returns from mortgage-backed securities. Many assumed that housing was a guaranteed path to wealth. Lenders, analysts, and rating agencies reinforced that idea, often ignoring risks buried in complex financial instruments. Collective confidence amplified itself. Caution was treated as unnecessary or even pessimistic. When the underlying fragility was finally exposed, the market reacted violently. Losses were rapid, widespread, and deeply felt. The AI bubble resonates with this feeling, though in a different sector. Headlines tout record earnings, revolutionary models, and billion-dollar funding rounds. Investors act like the pace of innovation will insulate companies against normal market pressures. Infrastructure spending is framed as indispensable for dominance, not as a potential financial burden. Optimism multiplies. Skepticism, much like in 2008, is often dismissed or ridiculed. Media narratives amplify this. In 2008, positive housing coverage fueled the frenzy. Today, reports about breakthroughs, compute milestones, and sky-high valuations create a similar echo chamber. Each new headline reinforces the belief that growth will never stop, overshadowing costs and vulnerabilities. Enthusiasm becomes self-reinforcing. Warning voices struggle to be heard. Investor psychology is central. Early gains reinforce confidence, attracting more capital, which inflates valuations. Success stories dominate, while failures fade into the background. Fear arrives, but often too late. By the time warning signs emerge, sentiment has already peaked, and corrections, when they come, are abrupt. Burry's warnings highlight precisely this gap. The lag between underlying structural risk and public recognition. The mechanisms of overconfidence are also familiar. In 2008, lenders assumed housing prices would always rise. Today, some investors act like AI-driven business models guarantee exponential returns. In both situations, collective optimism reduces scrutiny when almost everyone buys into the same narrative. Small errors or hidden risks are amplified, sometimes catastrophically. There's also a contrast between what the public sees and what's really happening. People observe revenue growth, stock price appreciation, and technological breakthroughs. What they don't see are hidden replacement costs, aggressive depreciation policies, or hardware that's aging fast. In 2008, vulnerabilities were in complex derivatives. In today's market, they are embedded in accounting footnotes, CapEx spending, and accelerated asset cycles. The principle is the same. The surface looks strong, but the foundation can be fragile. Finally, the hype versus fundamentals tension remains a constant. Investors often take short-term success as proof of sustainable long-term growth. Enthusiasm drowns out caution. When that happens, the same behavioral dynamics repeat. By comparing 2008 and today's AI surge, it becomes clear that while technology evolves, human market behavior does not. Recognizing this mirror is essential for understanding Burry's warnings. He doesn't buy into the hype. He studies the structure beneath it. He scrutinizes costs, accounting choices, and the life cycle of assets. By doing so, he interprets risk differently than the majority. That perspective connects the past with the present and reminds us that even in a fast-moving technological world, human psychology is remarkably consistent. Looking forward, the questions are not whether AI will transform industries, and unquestionably, but how markets and companies will adapt to the hidden pressures Michael Burry has called out. Understanding the road ahead requires examining potential outcomes, structural vulnerabilities, and lessons from historical patterns, without assuming either dramatic collapse or miraculous growth. One scenario involves a gradual correction. Infrastructure costs, replacement cycles, and depreciation may increasingly squeeze margins. Earnings reports could begin to reflect more realistic expenses, forcing investors to reevaluate growth assumptions. This kind of adjustment is subtle, but real, allowing the market to reset without immediate chaos. Another possibility is a sudden recalibration. If multiple companies report weaker than expected earnings due to accounting adjustments, or if demand slows, sentiment could shift quickly. What looks stable might suddenly appear fragile. When corrections come fast, they are often magnified by leverage and herd behavior. Investors, assuming growth would persist, might react sharply, triggering volatility and sharp valuation moves. There is also a mixed outcome scenario. Some companies may navigate these pressures gracefully, those with conservative accounting, strong capital discipline, and realistic depreciation policies. Others, less cautious or more aggressive in their accounting assumptions, may face tougher corrections. This divergence highlights Burry's core point. Risk is not uniform across the AI sector. Beyond individual companies, systemic lessons emerge. Innovation bubbles rarely destroy technology. They expose flawed assumptions. The dot-com crash didn't end the internet. The housing crisis didn't end homeownership. Similarly, today's AI correction may not slow progress, but it could reshape how value is assessed and risk is managed. The true danger lies not in technology failing, but in markets misrepresenting its cost. Burry's perspective underscores a fundamental principle. Prudence and structural analysis matter. By studying detailed financial metrics, he identifies vulnerabilities before they collide with market sentiment. His message is not doom, but a call for clarity. Growth without accounting discipline can be dangerous. The road ahead is defined by awareness, not certainty. Investors, analysts, and observers must weigh both the promise of AI and its hidden burdens. Rapid innovation brings opportunity, but it also magnifies the impact of miscalculations. By learning from history, focusing on fundamentals, and heeding voices like Burry, it's possible to navigate a future that is exciting and complex, but not reckless. Key takeaway: the future likely includes a blend of innovation, adjustment, and caution. Some companies will thrive, others may be exposed. The biggest risk is not from technology failing but from optimism ignoring the math. By confronting hidden structural pressures, investors can approach this AI era with both ambition and humility.